If you look at modern Japan today, it's hard to believe that the country's economy has been stagnating for over 3 decades. The Japanese themselves even have a name for this period, the Lost Decades. In this video, I want to tell the story of the financial crisis that led to this prolonged economic slowdown, and explain why Japan is still struggling to overcome its consequences. During the 1980s, Japan's economy was rapidly conquering markets across the United States and Europe. While every product had its own unique strengths, the success of Japanese manufacturing rested on 3 key principles: innovation, exceptional quality, and competitive pricing. Japanese products were often better than their Western counterparts while also being significantly cheaper. Take the automotive industry, for example. A common belief is that Japanese cars became popular in the United States during the 1973 oil crisis, when soaring fuel prices forced Americans to abandon large, gas-hungry domestic vehicles in favor of smaller, more fuel-efficient Japanese cars. While this certainly played a role, it tells only part of the story. In reality, Japan's rise was the result of a coordinated strategy between the government and private manufacturers. The government heavily subsidized exporters, encouraged banks to lend to export-oriented industries, and deliberately kept the yen weak against the US dollar and other Western currencies. These policies made Japanese products much cheaper in overseas markets. In return, companies receiving government support were expected to maintain strict quality standards and continuously improve their products. One of the best examples of this approach was the Toyota production system. This revolutionary manufacturing system enabled Toyota to build cars faster, more efficiently, and with far fewer defects than its competitors. It also accelerated innovation while reducing production costs. Thanks largely to this system, the relatively small and agile Toyota began outperforming the industry's giant General Motors. During the 1980s, GM employed roughly 750,000 people and produced around 8 million vehicles annually. Toyota, by comparison, had only about 65,000 employees, yet manufactured approximately 4.5 million cars. That meant GM produced about 10 cars per employee each year, while Toyota produced nearly 70, an astonishing difference in productivity. A similar transformation was taking place across many other industries. In consumer electronics, Japanese companies became global leaders in innovation. The VCR, CD player, and digital camera are just a few examples of products that achieved enormous commercial success around the world. Although electronics exports were not as economically significant as automobiles, they had an even greater impact on consumer perception. They established the Made in Japan label as a symbol of cutting-edge technology and outstanding quality. Once that reputation became firmly established, American investors became increasingly interested not only in Japanese products but also in Japanese companies themselves. After all, when Americans love a brand, they often want to own a piece of the company behind it. The only problem was that Japan's stock market remained largely closed to foreign investors. As a result, American investors watched from the sidelines, waiting for an opportunity to enter what many believed would become the world's most promising market. That opportunity arrived in the early 1980s. By then, many analysts believed it was only a matter of time before Japan surpassed the United States as the world's largest economy. Such a prospect deeply concerned American policymakers. The fear wasn't simply about losing economic leadership. Many worried that Japanese competition would wipe out entire American industries, weakening the country's technological leadership as well. At the same time, America's trade deficit with Japan continued to grow, while Japan had become one of the largest creditors of the United States. Washington decided it had to act. The first step was to negotiate the removal of capital controls and the liberalization of Japan's financial markets. The goal was simple: encourage foreign capital to flow into Japan. As investors bought yen to purchase Japanese assets, the currency would appreciate, making Japanese exports less competitive. Here's a simple example. Suppose a Toyota costs 2.5 million yen. At an exchange rate of 250 yen per US dollar, that car would sell in America for around $10,000. But if the yen appreciated to 100 yen per dollar, The exact same car would suddenly cost $25,000 without any change in its price in Japan. Normally, Japan's central bank could have offset these currency inflows by purchasing foreign currency and preventing excessive appreciation. To eliminate that possibility, the United States persuaded Japan to sign the Plaza Accord in 1985. Under the agreement, Japan committed to allowing the yen to appreciate significantly against the US dollar and several European currencies. For international investors, this was an extraordinary opportunity. Not only could they profit from rising Japanese stock prices, but they could also earn substantial gains simply from currency appreciation. Imagine this. In 1985, the exchange rate was roughly 250 yen per dollar. If you invested $1,000, you would receive 250,000 yen. You could then purchase Japanese stocks or real estate. Even if the value of those assets never changed, by 1988, the exchange rate had strengthened to approximately 125 yen per dollar. Simply converting your original 250,000 yen back into dollars would give you around $2,000. Your money would have doubled without any increase in the underlying asset, purely because of the appreciation of the Japanese currency. This flood of foreign capital drove Japanese asset prices to extraordinary levels. The Nikkei index soared from around 10,000 points in 1984 to nearly 39,000 by the end of 1989. Stock prices rose much faster than corporate profits. Investors were buying future expectations rather than present earnings. The average price-to-earnings ratio of companies in the Nikkei reached nearly 70. For comparison, a price-to-earnings ratio of 30 was already considered extremely expensive in the United States. But investors believed Japan represented the future. They were convinced its innovative companies would dominate the global economy, and they were willing to pay almost any price to own them. There was just one problem. The strengthening yen severely damaged Japan's export-driven economy. As Japanese goods became much more expensive overseas, exports slowed, and corporate profits came under increasing pressure. For an economy built on exports, this was a devastating blow. As Japanese companies began reporting weaker than expected earnings, investor optimism quickly evaporated. Stock prices collapsed. The Nikkei index collapsed to around 7,000 points and, remarkably, failed to fully recover from its peak in 1989 for decades. Japan entered a prolonged period of economic stagnation that initially became known as the Lost Decade.